Hello, everybody. Happy Monday. We are July the 28th. And if you're watching at this odd time, it's because I'm actually traveling and I'm in a completely different time zone. So we're going to be sticking to 10:30 regardless of where I am and whatever time zone I am. So if you are watching this live, thank you for tuning in. And otherwise, you can catch it on the replay on Facebook or YouTube. So thank you. My name is Hung Lu. I am with Cash Property. And on today's episode of Money Matters, we're going to talk about something really super fun, even though every single episode is super fun. But this one is very in alignment with the way I want to live my life in terms of traveling and having fun and not being so worried about being buried under debt. Okay. And so part of what I do is I teach families how to be mortgage free. And so in today's episode, we're going to talk about an alternative way to be mortgage free in under 10 years. Okay. The idea is the same in terms of hitting that principal amount as quickly as possible, as fast as you can, and just being consistent with paying down that principal. So hopefully that concept comes through in this idea as well. So before we get into the short calculation, I just want to say, if you're taking the time to watch these episodes and to increase your understanding of financial literacy, thank you for doing that. It will make a huge difference in your own life and in your family's life and in the generations that come. A lot of us don't think about 30 days from now, right? Like we're so into this instant gratification thing. And so I just want to say thank you. If you're taking the time now to learn how to handle money, it will go a long way because it will just be passed on to people around you and to the next generation. So thank you for doing that. Okay, so other than that, let's just jump right into it. So the alternative idea that I'm going to talk to you today about how to be mortgage free in under 10 years. It's it's a mindset shift, okay? And yet there's a lot of people already doing this. And so if you can grasp it and if you even if you try this for a week, a month, a couple of months, you'll be converted. Okay. So I'm totally converted on this already. I love this idea. So this is where you basically trade in a traditional physical home for a camper van, a traveling van, one of those super nice special vans that you can buy that have everything that you need built right into it. Okay, so let's go into the quick calculation and I'll show you why having this, a camper van actually makes super amazing sense. And if you are, okay, so I'm going to talk from my perspective of being a single mom with one kid. Okay, but you can be any stage in your life, and this could make sense for you. So I know families with 2 to 4 kids living in a camper van. Michelle, I'm thinking about you. Hello out there. And then some other families I know that have like, 3 to 4 kids all living in a camper van, 2 parents. Okay. And then I also know individuals who have downsized, who've got those physical houses, and they're just like, you know what, we're just going to downsize. We're going to minimize everything that we have and just have that freedom to be able to move around and not be bogged down with this big, massive mortgage. Okay, so let's go through a calculation and see what applies to you, see what you can pull out, and maybe make it relevant for your life. Okay, so here we have a camper van. I'm just putting it in here at 50,000. And I'm going to assume that, and I'm actually thinking about doing this between my Toronto properties and being in BC and just having 2 camper vans that we can use. Okay, and one would be actually just a winterized van that we can take out to potentially Whistler and just go skiing on the weekends with and just have a base without having to physically buy an investment property in Whistler. Okay, but then also having a camper van in Toronto so that when we're traveling around in our Toronto properties and just making sure everything's working, that we have a base. Okay, so I'm just assuming that there's no cash going in. Okay, so I'm going to actually be taking out a loan for $50,000. And this loan can be from a HELOC, from a credit card, from any source. Okay, so the math behind this loan amount is whatever amount of cash I'm putting in, um, taken away from the camper van amount. Okay, so the 50,000 minus whatever cash I'm putting in is going to give me my loan amount. So I'm going to assume that I've got a 6% interest rate here. So this is because that's what the HELOCs are averaging around for. Okay, so that means my annual payment on this camper van. Now I'm calling it a camper van, but this is the type of van that would be, it would allow you to be off grid, meaning that it's got solar panels, it's got a bathroom, a mini kitchen, it's got a cooler, a fridge, everything that you need. Okay, even a bathroom. So now some of the things that you might not have in there, it really depends on the size, right? Like I know some of these camper vans have a built-in all-in-one washing, like a washer and dryer. Okay, so those are for the larger families and for the ones who don't want to be, tied down to certain locations. Okay, so this one is those fancy ones that I'm talking about. Okay, so 3,000. Oh, let me make this bigger here because I know some of us are um, vision impaired a little bit. Okay, so the annual payment, okay, is $3,000. Okay, now if you're sitting there going, Hong, you know what? I can't downsize into a camper van. You know what? It's a mindset shift, okay? Because a home is not like it's just a physical place. A home is really where your heart is, where your interest lies, where you wake up and you can be like you can be like human being, okay? Like being. Okay. So this one here, it's an annual payment of $3,000. For some of us, that's our rent amount. For some of us, that's our current mortgage amount a month. Okay. So think of it. You're automatically getting rid of 11 months worth of bills that you don't need to pay because you're paying interest on this camper vans and it's equivalent to about $3,000 a year. Okay. So the way to calculate that is you just take your 50,000 times that the interest rate of 6%. Okay. That's how you get your interest payment. Okay. Now, if you want, you can take that and divide it by 12, and that will give you your monthly payment. Okay, so I'm comparing it to a rent of 1,500 a month. So for those of us who have rent control or who have super cheap rent, 1,500 is reasonable. Okay, for some of us, we're paying 2,000. Some people I know, like I was looking at some North Van properties, they're asking 10 to $20,000 a month. Okay, so I don't know who they're targeting, maybe traveling executives. Okay, that is to me is just insane in terms of the rent amount. Okay, so let's just say your rent amount is 1,500 a month. Okay, well then that means you're paying 18,000 a year just in rent. Okay, now this is to somebody else. Now if it's not rent and a mortgage, let's say, so I'm gonna update this. So this could be a mortgage as well. Okay, so if you are paying a mortgage and you're paying 1,500 a month, well that's 18,000 a year. Okay, so if you're paying that, hopefully it's a rental or hopefully you've got a rental suite in there to help you as a way to cut down on that mortgage. Okay. So let's skip this part for now because I want to go and show you the math around $50,000. Okay, so the idea here is that you pay the monthly interest on that loan. Okay, but then the additional thing that you do, and this is the big thing that I want you to take away from this, if nothing else, even if you don't go into the camper lifestyle, okay, any loans that you do, any mortgages, credit cards, anything like that, take the additional amount of money that you would have paid to the rent, the mortgage, and put it towards this debt that whatever you're doing instead of. Okay. So, for example, when you refinance your property and the rates have gone down, okay, I know that hasn't happened for for a lot of us in the last few years, but there were times when the rates were higher and then when we refinance, the rates were actually lower. Okay. In that case, whatever that delta is that you saved going forward, put that in as part of your monthly payments. If you, let's say, got a raise, that difference between your old salary and your new salary, that difference, put it towards the principal of your mortgage. Okay. Like you were already living at that base amount. Okay. So it's not going to change your lifestyle to take that difference and put it towards the principal. Whatever difference here that you're able to save in rent money because now you bought the camper van and now you're not paying $1,500 a month or $2,000 a month, you're already paying that. So take that amount and put it towards your balance. Okay. Now you could be like, okay, well, let's run the numbers on instead of just the 15, but what if you had to take off the interest payment? So then every single month would be that 15. Okay. So we're going to leave that calculation and just show that in the second part. Right now, I just want to show you if you could handle 250 a month, because look, the 250 amount actually goes down every month. So the most that you would pay of new cash, sorry, I did the formula, thought I was copying it down. Okay, so that the most you would ever pay new money would be 250. Every single month after that is going to be less than 250. Okay, so you can see that math there. Okay, so I'll go into and show you how that math came out. So so you're going to have to pay 250 as the new interest on the 50,000. So you make that payment of 250. So it's just an equal to. Then you have your old rent amount that you're expecting to pay. So you put that right into the mortgage pay the payment of this van as well. So that means that the difference here, which is your 50,000 plus your 250 minus your 250 minus the 1,500, that gives you 4,850. Okay. And then that carries over to the next month. Now, this 4,850, that interest on that has gone down because that 6% is not on the 50 anymore. It's on the 48.5. Okay. So now your interest on that is your 48.5 times your 6% divided by 12. That will give you that monthly payment for that month. Okay. And you'll see every single month it's the same formula and it goes down because every single month what you're doing is you're taking the full 1,500 and applying it to that full balance amount. Okay. So this is fantastic. So now every single month you're going to hit that down and look at that. It's going down every single month. Okay. So now when do you actually pay off this 50,000? Look at that. In month 34. Okay. Now, if you're quick on your math like I am, 34 is less than 3 years. Okay. You would be able to pay off this van in under 3 years. And now you don't have a loan, and now you don't have that 1,500 that you need to put towards this camper van anymore. Okay, so what does that mean? So I'm going to go up here and I'm going to update this yellow cell because this is the one manual cell that, okay, so 34 months, that's under 3 years. Okay, so the interesting thing is, okay, like, because when I share this idea with people, they're like, well, Hong, what about the maintenance fees on your van? Like, you're going to have new tires, you're going to have to get servicing, you're going to have to blah, blah, blah. Okay, whatever the reasoning is. Okay, well, think of it this way. If you give up your home, now you don't have property taxes, you don't have insurance on the home, even though you have car insurance now, you don't have utilities. Okay, so it's a different type of bill payment every single month. Yes, you're going to have to do the oil change, the tires, and all that stuff. But now you don't have the utilities. So it's sort of like a wash, okay, between do I have utilities on the physical home or do I have the maintenance fee on the vehicle? Okay. So the same thing. So now for me, I would get a Starlink as well, and I would also utilize places for free internet. Okay. For myself, it would need to be big enough for two people. So when we were living out of RV, we had a 31 footer, and that RV was actually 25,000. So let me see here. So can I go here and update that? Okay, so let's go here. I'm going to update and show you what the camper van would look like at 25. Okay, and so I actually paid all cash for this, but look at this. Within 17 months, in a year and a half, if I didn't pay out in cash, I would have been able to potentially pay this out in a year and a half. Okay, and be completely mortgage free, basically not having to pay rent and having the freedom that we had for the 2 years, which is what we did. Okay, now the great thing about this is that when I ended up selling this camper van, I actually got the full 25,000. It actually did not lose value. Okay. And it didn't gain any value either, but the camper van was 20 years old. Okay. So just a few considerations here. Okay, so the gym membership to access the showers, and then there are community centers that do have shower facilities as well. Okay, so the one risk that I could really think about is really just the rates going up. Okay, so those are sort of the considerations there. So now let's go back and run the calculation. So let's say here we're buying the camper van for 50,000 because the ones that I'm looking at now are, at that price tag. So 50,000 would sort of be the base of it. Okay. So now let's just say that the the monthly payment, I want to just cap it at 1,500. I don't want it to go over 1,500. So I would update this formula here to be 1,500 minus whatever interest payment I'm paying for that month. Okay. So the difference here would be the 1,250. So you could see the balance here has changed just a little bit, right? So I now have to have a little bit of extra owing every single month. So now it's going to update there. I'm going to update this formula here, and I'm just going to copy and paste that down. Okay. And so you'll see now instead of 34 months, it took me 37 months. Okay, not that big of a difference. We literally went from 34 months to 37 months. So an extra 4 months. Okay. Let me see here. Did that make sense? Yeah, because I'm balancing it out so that this plus the interest that I'm paying towards the loan from the 6% would be coming out from the 15. So that 15, yeah. Okay, so the math there works. So this one here, so 37 months now instead of 34. So basically just a 3 to 4 month difference. So if you really wanted to cap your payments at whatever current rent that you're paying at, that's how you would do it. You would just basically say, hey, you know what? I want to pay 1,500 no matter what, and then just do the difference. Okay, now some of the vans, so I'm just going to do one last iteration on this. Okay, now, let's just say that you decide to get one of the fancier vans, okay? Because there are some out there that are like 100,000 to 200,000 and something. Okay, so let's go up and bump up this 50,000 to 100,000 and see where that takes you in terms of time to pay it off. Okay, and I'm also just going to do a quick note here just to make sure that I am not missing any of the major points that I want to make sure that that you get. Okay, perfect. So here we go. So we got 100,000 there. Okay. And so now we are sticking to keeping it at 1,500 no matter what. Okay. So there's your 100,000. And then the first month is 99. And then it just basically decreases. So let's figure out where you would become. Oh, okay. So it goes past the 70 month time frame. Okay, so I'm just going to copy this down. I'm going to go down to 90. Let's go down to 100 months. Okay, so there we go. 82 months, okay, is the time frame there. So 82 months. So I'm going to go back up here and manually change this to 82 months. Okay, so that takes you to about under 7 years. So if you wanted to buy a fancier van at 100,000, okay, it would take you under 7 years to pay that off. Okay, so way faster than the 10 years that we teach on the mortgage course on how to be mortgage free under 10 years. Okay, so the same idea, right? Hit it hard with your principal, whatever extra cash you have, hit it against the principal and just make that payment come down as quickly as possible. Okay, so as you can see, a completely different alternative lifestyle. On these Money Matter episodes, we don't just talk about buying investment properties. This is an alternative to that because if you bought this camper van and you're like, you know what, I only want to do this half the time. Well, guess what you could also do with a camper van? You can actually rent it out. Okay. There are RV rental, sorry, RV rental websites that you can go to. The only thing with that is that you need to make sure that your camper van is newer than 20 years. Anything older than 20 years, there's a bit of a liability with that. And so they don't allow you to rent that out. So you want to go with stuff that's newer than 20 years. Okay, and then you can actually make money on that. And that's actually interesting because I did find a website. Somebody was advertising selling their camper van business where they had only been testing it for about 3 months and they made about $5,000 and they were actually trying to sell it to somebody, the value of the camper van, which they were trying to go for like 50 to 60,000, which was a little bit insane. So the math did not pan out there. Okay, so that is what I have for you today on today's episode of Money Matters. I am your host, Hong Lu. Thank you for watching. Have a wonderful week, everybody.